Okay, so I'm going to do some brief introductions, and then we're going to have a prompt that will allow our speakers to introduce some of their big picture thoughts for 3 or 4 minutes, and then we're going to get into an extended dialogue on our topic. So to my immediate left is Giuseppe Bivona, who's a co-founder at Bluebell Partners. He's a self-described activist investor. He's taken on companies such as Richemont and Danone, and has a current campaign against Bayer, and is also known for leading a campaign to remove Larry Fink as the CEO of BlackRock. To his left is Matt Cole, who's the CEO and Chief Investment Officer at Stride Asset Management. That's a company that was, or an investment fund that was founded by Vivek Ramaswamy, who is currently a candidate for president of the United States. He previously worked at CalPERS and knows one of our other panelists. To his left is Tariq Fancy, who used to be the Chief Investment Officer at Sustainable Investing at BlackRock, and as Anjali mentioned, is the author of a quite interesting book called Secret Diary of a Sustainable Investor. My co-host, Ethan Klingsberg, is next to him. He's the head of corporate practice at our presenting sponsor, Freshfields, and does quite a bit of work with boards who are the targets of shareholder activists. And at the end, we have Simpson, who is the global head of sustainability at Franklin Templeton, and used to work with Matt at CalPERS. So they put out voting proxy guidelines. There's a lot of public and private communications with boards of directors about what they want to see from public companies. And this has the potential to make things difficult for boards, right? They're getting different signals from different sorts of institutional investors. How do they synthesize those messages? And so the question I want to pose to our speakers is this a product of healthy debate? Is this a good thing, or is this something that's a structural or substantive problem that we need to think about? So, Giuseppe, I'd like to invite you to share your thoughts first.
Thank you. Look, my biggest concern as an activist investor today is not the relationship between shareholders and the board and directors in general, because clearly the board is a fiduciary to the shareholders. And if they fail to fulfill their fiduciary obligation, there are remedies around it. Obviously, you can, as a shareholder, remove the board of directors, you can sue them. My biggest concern today is something different. It's the fact that we have 5 constituencies. So I'm referring to 2 leading proxy advisors and 3 dominant asset managers in the space of passive fund, which effectively control the outcome of any AGM for any major company, and they are not capital owners. And I think roughly you can say that they both control, despite together, say between 20 and 40% of the votes on AGM, which can be attended by 70 to 80%. I think obviously they can dictate the outcome of any ballot. If you add to this, that based on our experience, I see a lot of situations where very irrational decisions are made. I'm not referring to ESG decision, which is a bit of everybody, but on very solid and sound, I would say, item to be voted at the GM. Then I think that there is a serious risk that democracy in corporate is a risk. And actually I go a step further to see that based on our experience, in many situations, even we don't realize this democracy is not there any longer. And I believe the regulator and policymakers should address how to break the oligopoly created by, again, proxy advisor, and also how to deal with passive asset manager who clearly in many situations play a very unhealthy role in AGM.
Thank you. We'll work from the outside in. Anne?
Thank you. I wasn't expecting that. I thought you would quietly work, orderly
work.
We're
outside in.
And I would sit there and listen to all these clever people say wonderful things, and it would then not be easy to wrap it up. Never mind. So look, the basic idea of the corporation requires the owners of that company to exercise their fiduciary duty. There is a fiduciary duty for the directors, but they don't just pop up out of nowhere. I mean, when we go back through British history, you will see that the idea of a company was actually banned for over 100 years. So when we think we've got controversy right now, go back and take a look at the Bubble Act of 1722, which, you know, corporations down in the South Seas had essentially bankrupted the monarch, brought the company to the brink of ruin, and the solution was, we will never have another company. Oh, we need to trade. Okay, well, you can do that for a royal charter, which is how vast entities like the empire, the organs of empire for India and Africa and beyond. So, and even looking at free market enthusiasts like Adam Smith, he points out that without control being put in place, as he called it, negligence and profusion will prevail. The joint stock company on its own. So, as I think it's Lord Ascot, power corrupts, absolute power corrupts, absolutely. So when we're talking about governance, or the G in ESG, we are essentially talking about the exercise of accountability. Now, if we look at the size and scale of the financial markets now, this is not a simple matter. Millions of people putting their hard-won, hard-earned savings into a system, not just for fun or to enrich a few privileged and lucky people, but to pay for the basics of welfare, for pensions, for healthcare, for education, for saving for a rainy day. So our financial system globally is now broadly fueled by the savings of ordinary working people. The sovereign wealth funds, maybe you say the taxpayer has a hand in it as well. This poses a whole new idea, which is that the financial system is also there to serve a social purpose because of the objectives of the people who the money belongs to. So, Giuseppe, I completely agree with you, focusing on issues of control, monopolistic behavior, oligopolies and all that jazz, really important, and our previous speaker shows us exactly why that is so. Competition is so important. But that misses the point that these managers, Franklin Templeton included, we're investing other people's money. So the big debate we all need to be having is about not corporate governance, it's investor governance. What are the lines of transparency and accountability so that people's money is being invested according to their needs and wants over these very long time periods? So that's a big complicated topic, but I don't see it really surfacing in some of these, you know, the acronym versus the acronym trade-offs that's going on at the moment. We've got to understand the function of finance is there to serve. It's called financial services, but finance needs to be the servant and not the master. And getting ways to have finance in service to the real economy and producing returns for the people for whom it is the savings vehicle for their future, as well as making sure we're dealing with all these corporate issues that we prefer to talk about. But investor governance, I think, is the golden thread that we've really got to start weaving through all of these conversations, recognizing who the money belongs to. It's other people's money. It's not Larry Fink's, it's not Jenny Johnson's, it's other people's money. And that poses a fiduciary duty that we need to not only understand, but we need to honor. And that's why a big part of this debate about the acronym ESG is sort of a distraction in the sense that it's been an awkward acronym from the beginning because those three letters of the alphabet do not include the letter F. You've all heard me say this before, I know. It's an old lament on my part. And when I was at CalPERS and had the role of building the strategy there, we used the concept of sustainable investment, not ESG. We didn't try to invest in ESG product. That was not part of the strategy. It was saying we're universal owners and we have to be part of the transforming of the system that will generate those returns. And the model for us was economic. It was saying there's financial, there's human, and there's natural capital. The stewardship of all three is where risk arises, but it's also how value gets created. And if you start thinking about investment and fiduciary duty in those economic terms, the sort of, you know, the noise around the acronym really is not the driving force behind this. It's the need to generate repeatable risk-adjusted returns. Trusted their savings to fund managers. So thank you.
Thanks. Matt?
Yeah, I think Giuseppe and Anne covered really well. It's part of some of the structural problem or just concern that we're talking about, the rise of index funds, even public pensions like CalPERS that are investing on behalf of someone else. That someone else is the end asset owner. It's law enforcement officers, nurses, teachers, other everyday citizens. So that gets to the question of what do those people actually want from the asset managers that are managing money on their behalf. I and Strive firmly believe that the average citizen just wants an asset manager to maximize risk-adjusted returns on their behalf and also keep companies out of social or political issues that aren't associated with their mission. And I think that gets to what I'll call a disconnect between the managerial class who thinks that corporations have a social purpose or must serve a social purpose, and the everyday citizen that, as a whole, I don't think actually agrees with that. And what I see in our country is a retirement crisis. Almost every single public pension is underfunded. 401ks do not have enough money to support Americans in retirement. Social Security, also a mess. And so when we think about us as an asset manager, we have to try to ethically maximize risk-adjusted returns, period. And that gets to the point where I would say that the debate on pro-ESG or anti-ESG, whatever you want to call it, is actually the wrong debate. And the correct debate is actually upstream of that. It's the what is a purpose of a corporation. And our belief is firmly that in that of shareholder primacy and shareholder capitalism, that the fundamental purpose of a for-profit corporation is to maximize long-run value to shareholders. Many other asset managers today actually take the other side. They've explicitly rejected shareholder primacy and moved toward a stakeholder model to serve broader societal interests. I think that's a massive breach of fiduciary duty. And if it's actually successful, if you move American corporations away from shareholder capitalism, which has been the fundamental model in America for the past 100 plus years, to the European model of stakeholder capitalism, I think the returns on a forward-looking basis to the stock market would be horrendous, possibly over 3% lower returns, terminal returns going forward. And if that's correct, you would basically bankrupt almost every single public pension in America. It would be drastic. So that is the what. The what is the purpose of the corporation. Downstream of the what is the how. And for Strive, we call it excellence. That's how we think, how we implement maximizing returns. That corporations should focus on providing excellent products and services, hiring the best candidate for a job, period, regardless of the candidate's sex or race. And also just staying out of political and social issues and staying focused on their mission. We think through that, you maximize returns. You can have the debate on ESG downstream if you first agree that the fundamental purpose of a corporation is to maximize value. If you move away from that and then downstream look into ESG issues, I think that's where you get into really muddy waters of you've moved away from saying that the purpose of a corporation is to maximize value, then you get into some of these E or S issues. I think that's where you see a lot of debate of, are you actually doing this to provide value to shareholders or is it for another reason? And that's, I think, one of the big issues with this index fund issue that we're talking about and a sign of unhealthy debate in corporate governance.
So this is all interesting to hear about investor governance and how we're going to keep the corporation perhaps in their lane and they're just going to pursue shareholder value. And then Giuseppe's point about, well, these guys are dominating the influence on corporations. So let's just take a step back and look at a few recent examples from the perspective of, let's say you're in the boardroom of a publicly traded corporation. So one development that just happened 9 days ago was there was a rule put in place in 2017 that said any company that had multi-class or dual-class share structures was not allowed in any of the S&P Dow Jones indices. And so this was governance. It was sort of a collective action governance move. And then 9 days ago, that was completely repealed. And when it was put in place in 2017, S&P said, we've surveyed market participants, and 80% of market participants said they are opposed to high vote, low vote share structures. And that's why we're putting it in place. They didn't give any details about how their surveys came out this time. But I think the clear message is, and this goes to your point, Matt, is people want returns. I don't even think, though, that they necessarily want any role in governance, though, if they just want the return and having a say. Clearly they're saying, fine, you could have no vote companies. This was not just, sometimes there were other options. They could have said, well, we just won't let companies in if they don't provide that a minority of the board can be elected by the low vote shares, or we just won't let companies into the index if there's no vote shares, or if they don't have a sunset date on the high vote, low vote at some point over the next 7 years. But no, they said anybody's allowed in because everybody wants to buy the index. Then other big development recently was one of the activist funds, Trian, made a very substantial bet, nearly, I think it was in the $1 billion range, in Disney. And one of their primary issues was governance. They said there were issues on compensation, on shareholder engagement, on succession. And then Disney, and they said, we got to get on the board to fix this. And then Disney said, we're cutting costs, making a couple of strategic operational changes. And then everything was fine. So clearly the message that comes out of that, and certain other recent activist situations, is returns are what matter, not the governance. So then, and I think this is just indicative that we live in an era where there's such extreme pressure in the boardroom to maximize returns, to maximize that share price in the near term. And what does that lead to? So this idea that companies are not concerned with social and political issues, I think is not true, because they're under such pressure that they're basically also controlling the government. If you just look at, almost, I think 49 of the 50 largest lobbyists are all funded by public corporations. I think at the ratio of money spent on lobbying between corporations and labor is something like 16-1. So the lane is very large. We're definitely not in the era back where to be a corporation, there were lots of rules and restrictions put on you. That's over, right? We're in this thing.
Write the rules.
Yeah, now they write their own rules and they're controlling their own rules. So everything goes. So then what happens? So once you're doing that, and this goes back to people like a lot of the conservative economists said, once corporations are getting so involved in what normally should be done by the legislature, then what happens is you start going after the corporations because of public issues that really should be within the purview of the legislature. And I think that's what's forcing this so-called ESG movement, is because the corporations are so all over everything, and there's this it's not so easy. It's much easier to say, yeah, if we want to fix climate change, pass some laws. Don't go to BlackRock. BlackRock isn't the one who's going to fix climate change, but it's very hard to fix climate change given the way corporations, their role in the way our democracy and our legislatures work. So then we're left with, well, what's the angle? And I think from my experience, the one vulnerability or opening that I see for all this is, starting with Sarbanes-Oxley, there's been this proliferation of professional independent directors, and they love their positions. They really do. A lot of them, they are very sensitive about how they perform as far as ISS recommendations, how many votes they get. It means an awful lot to them. And that's an opening, right? That's one opening. And So if ISS is saying we're going to recommend against voting for any director who's on a multi-class or dual-class company, which they are now doing, that means something to these directors. And so I think that's the one area, and it may not be the best way of running a society, but that's what we've set ourselves up for. So that's why this is rushing in, because this is a vulnerability where you have these very sensitive souls on boards who don't like to be criticized. And so you have this opening, and that's where all of this action is now being directed. And I understand the frustration, but on the other hand, that's where we are. So it's sort of a loop where we're going from having a situation where there's no role and we just let the corporations run free because we're so focused on returns for the firemen and the policemen, et cetera. And then on the other hand, where there is this societal push to want to influence, and the only opening is through these independent directors.
Thank you. Really interesting comments from my co-panelists. I think I'll try to zoom out a bit and see if I can give some thoughts on sort of big picture issues. And I'll start with a story of a conversation I had recently with a friend of mine who's a senior guy at one of the Canadian pension plans. And the Canadian funds, unlike the US ones, they hire pretty aggressively and bring people in-house, and they try to manage actively for 20, 30 years doing infrastructure and so on. And they're focused on a lot of mega trends, sustainability, climate risk, so on. And one of them is political polarization. And he gave me the example of Starbucks, which ended up on the wrong side of some open carry situation in Wisconsin and saw their market share plummet, and the emergence of what's called Black Rifle Coffee, which I imagine people in San Francisco have not seen much of or don't go to, but their logo originally had a machine gun in it, and there's some military link and so on. And so his thesis was, he said, look, if there are commoditized brands in a world that's becoming more and more polarized, people are eventually going to go towards the brand that's more interesting to them, right? Do you really need is cola, would you rather get the cola that tastes better or the one that aligns with your values? Most people can't even taste the difference. And so I'm reminded of a comment in the 90s. Someone asked Michael Jordan, they said, well, why don't you comment on politics? And he said, Republicans buy sneakers too. And I'd remind you, the Republicans also have 401ks, and they have, they want to buy ETFs. And if you look at what is most interesting to the ESG industry for asset managers, there's a lot of things in terms of data, framework, structure, so on. I suspect the most interesting thing to them are the ones that drive their incentives, which mean new assets and at higher prices, right? So they really want to sell ESG ETFs. And ESG ETFs, what's so interesting about them, having been a chief investment officer, a trained investor, went into the middle of it, it seemed that they were more aligned to a sales strategy for progressives, right? Particularly if you look closely at the S issues. A lot of them I would personally agree with, but I cannot tell you that it's an accident. I think that that they tend to lean towards all of the S issues that progressives care about, right? And or that it's an accident that they exploded in popularity after Trump was elected, right? I mean, that was an internal view that we had seen, which is that when you want the government to deal with these issues and he gets elected, everyone says, well, he's not going to do anything. Suddenly we're all neoliberals, right? We're trying to figure out what we can do with our investment funds and so on. And so I'd offer you two thoughts when you look at what's going on. One thing that fascinated me in BlackRock was I'd come from a PE hedge fund background. So it's 2 and 20, fee structure. And I'd never really seen that much of passive products, which at a place like BlackRock is 2/3. And suffice to say, as a CIO going anywhere near that, there's no investing at all about that. It's all automatically done. And so what's driving decision-making is marketing and sales, right? Mm-hmm. You gotta sell the product. It's a commoditized product, single-digit fees. So that's one thing I'd say is interesting. The second thing is that a big asset manager like BlackRock serves two sets of fiduciary. They're fiduciary two sets of parties. The investors, as we all know and we've talked about, also their shareholders. Mm. So here's the question. Is the value creation from an engagement team that is generally viewed for passive players as a cost center, right? A cost center against which you have these single-digit fees. Is their engagement driven by a strong sense of this is what's going to create value for investors? They own 5%, these are broad issues. They have lots of people covering lots of issues. I'm not sure it's going to move the needle. On the other hand, this could be a really attractive marketing strategy to push more product. Right. And if you look at ESG products, well, Republicans buy sneakers too, so now we have anti-ESG products. And no matter how you look at it, I think boards are going to be getting pushed in directions in the next few years where they're eating that political polarization and the marketing strategies attached to them, such that you're being told that do what these donkeys like, and then the other side says, no, either don't do what these donkeys like / do what elephants like. And both of them are convinced and tell you that this is what's going to make more money. I'd say generally the good, the bad, and the ugly. The good is that some of the E issues, I think, on the ESG scale may subside. I think a lot of the E stuff is actually more objective. I don't think it makes any sense to stop people from looking at risks, even if they're of something that people claim not to believe is real while they're, they don't believe the science while they're holding an iPhone. I think realistically that stuff might subside and was probably timed for gas prices, right, and maximum political theater. I think some of the S issues in ESG are probably going to grow because from everything I saw, they are very difficult to look at objectively, and they seem to do more with the culture wars and intergenerational friction in business and so on. I'd say the ugly, and I think the ugly is that we're not even having the right conversations. And I'd say, I'm gonna take 30 seconds to do a quick show of hands on something. I'm gonna switch topics here. It's the NBA playoffs. The Golden State Warriors 2-2 is the game tonight. Now imagine there's a basketball game and Draymond Green, I'm gonna use a Warrior because I'm here. Imagine Draymond Green comes out and everyone says, hey, the game's gotten really dirty. We have to clean up the games, people elbowing each other and this, that, and the other. And he starts giving a bunch of talking points on whatever he feels like saying on good sportsmanship. We have this new coach. We went to the hospital last weekend, blah, blah, blah. Then someone says, hey, that's all great. I guess you want to clean up the game. We also heard you're making secret payments to the refs behind the scenes. Would you mind telling us about that? And Draymond Green said, nah, I don't feel like, and he left. How many people here would view that as an honest attempt to clean up the game of basketball?
If you asked him to say, are you bribing the refs?
Well, the reason I bring not in so many words, but to build off your point earlier.
He admitted it.
To build off your point earlier, BlackRock, Disney, Netflix, and Boeing for years faced resolutions from their own shareholders asking them to disclose their political spending, which, as we know in the post-Citizens United era, is effectively traceless and limitless. All four of them fought off those resolutions. All four of them put out great CSR statements with lots of ESG stuff that went through the marketing team. The question I would ask, and this is the ugly of this whole conversation, is are we even having the right conversation, right? If we wouldn't let Draymond Green get away with it in capitalism, I'd submit to you we probably shouldn't let Larry Fink get away with it. Or if Draymond Green shouldn't get away with it in basketball, I don't think we should let Larry Fink get away with it in capitalism.
Can I add, just as a practical example, not the good fun one in the game. This is real life. It's been really interesting to me as the big investors have started to understand the impact of climate change, very specifically, because whether or not you believe in it, if you've got property that you own in a coastal area, you see that water, King Canute. You cannot, you can't send that water back. So, but what we've seen, and I'll just take climate action 100 plus as an example, is first of all a recognition there has to be a policy track. So the investor agenda is what it's called, runs in parallel to the corporate engagement. So that's important. But built into the agenda, into the benchmark, is political spending. So governance, competence, independence, diversity on boards, that's one piece. The just transition, what's happening with the workforce, CapEx alignment, emissions, all the rest of it. But it's very important to me that we have, as a community of fiduciaries, recognized that if we don't have transparency about political lobbying and the use of shareholder funds for that purpose, all the other stuff can't be really dealt with. So as we've seen shareholders winning those votes, I think it's a recognition that what Tariq and I were talking earlier, and I was saying, it's like we've got the invisible hand, the Adam Smith view of how markets work, and the visible hand of regulators. And the issue now is, are these two operating in the proper way? Is policy being generated through a democratic process in the United States, and what's the proper role of companies? So I think this issue of political disclosure and board oversight of that, making sure that political lobbying is in line with the corporate purpose, is absolutely fundamental.
But is there any limit to having your political spending in line with the corporate purpose?
Well, yeah, because if you're lobbying for something that you say you don't believe in, If you say your strategy is to agree with the Paris Agreement, and many do, it's all praise, marvelous, we can't have, we'll all be boiling, we keep temperature rise to 1.5, but the company is using your money as a shareholder to undermine regulations in that regard. I'll give you a nice example, BP, right? Some years back, was lobbying in Washington state against a cap and trade, effectively a form of carbon pricing. We win as shareholders this political donations thing, and guess what? They're back this time around a couple of years ago, and BP is not lobbying against that, and if anything is arguing why this is actually a necessary policy measure. So, even in the state of Washington, a British petroleum company can be affecting the outcome of politics, but that can change. I think that's just one small example.
I would like to come back to the example of a dual class of share, which I find quite interesting. Make an example of a campaign that we ran last year. Bluebell Capital Partner took a position in Richmond. Now, Richmond has two classes of share. We, the market, own 90% of the company, but we only have 49% of voting share. A single shareholder with multiple voting share has 10% of the company. Talk about $70 billion company, and he has absolute control. Now, we ask to put at the GM a resolution where, and according to the bylaw, the market asks, we can only have one director on the board, one out of 16, and we own 90%, 90 the company, and there's never been one for 34 years. So we asked to put a director, I was on the board. Then we say, let's increase the number of directors representing the market from 1 to 3. Board of 16, we own 90%. You know what BlackRock vote? They vote against. ISS, they vote against. And you know how they describe the resolution? Bluebell Capital Partners is asking to increase the minimum size of the board from 2 to 6. Because it's true, if two classes of shareholders, each one can appoint at least 3, the minimum size of the board is 6. Who bloody care of what is the minimum size of the board? We care of increasing from 1 to 3. ISS say no, BlackRock say no. And coming back to Tariq's point, that's why I'm very concerned of what's going on passive fund. Because, and I'm not in person with Larry Fink, I love it so much. But if you go and see what BlackRock voted in the 2022 proxy season, they casted 170,000 votes with a governance team of 80 people. Right. So what is the point here? That because passive funds are a few basis point problem, nobody has any incentive to do a proper job. I am sure that they vote in Richmond the way they voted because I didn't even read. 170,000 votes with 80 people. What are you talking about? You don't even know what you're voting. Let's mention what are you.
Tariq says it's a business.
But no, it's a cost center for BlackRock, and that's wrong. It shouldn't be a cost center. It should be a revenue center, and you pay for research. So there are ways to address this. You unbundle. For passive fund, there's nothing about investment. It's technology and marketing. So you want to vote, you don't vote. You unbundling because passive funds are not.
In other words,
they are not exercised.
So you let the investor in the passive fund be the one who votes.
I think you should get a passive fund where you should give the investor the choice to appoint 1 out of, say, 5, because 2 is no good, of proxy advisor who give them the vote recommendation. And investors should pay for that. Because the other concepts like ESG, we would like, the return, fantastic, we would like to save the vote, and everything is for free. No, things are not for free. Okay, there is a trade-off in everything, including in voting. Do you want the vote to be properly exercised? You pay for that. So you unbundle the vote, the managing of the ETF and the voting. Otherwise, you abstain. If I don't want to pay for this service, and I'm happy to own an index fund, the default should be abstain. But you don't vote no for having 3 directors as opposed to 1 in a public company where we own 90%, because that's an embarrassment to your own franchise.
But then Larry Fink's letter won't mean anything. His annual letter may not mean anything.
In fact, it means no. And I think a lot of people start to realize, certainly it means nothing to us, and it means nothing to him as well. They only live about the preaching governance. The guy has a leading, in the US, you guys know this market better than me. If you have a CEO and chairman, it's the same person, you need to have a lead independent director. Lead independent director is a director who's been there for 20 years. It's part of the furniture. Okay, how this could be an independent director doing the lead independent director? And this should be preaching governance to the rest of the market. It's a joke.
I would just say one comment on the proxy choice that's kind of coming out there. And even if it was perfect, and right now it's not perfect because your options are basically vote with the asset manager, it'll say BlackRock, ISS, Glass Lewis, or do it yourself. So choose your version of stakeholder capitalism or do it yourself as the current option. Let's say it gets better and there's actually a full slate of voting options, which probably will happen in the near future. It's still not a great solution because within corporate governance, proxy voting is just one part of it. Engagements are a huge part of proxy voting, are a huge part of corporate governance, both public engagements and private engagements. Putting forth shareholder proposals yourself are a great check on a corporation. And I worry that we get to this problem where, okay, BlackRock stays the largest asset manager. Yes, there's proxy voting choice, but the custodian of all the assets, the holder of all the assets is still BlackRock, State Street, and Vanguard. And so they still control. I would push back that the letter doesn't matter because they still have their name as the owner of this company if you look it up in Bloomberg. And so they still have an outsized power versus the person that takes back just the proxy vote. And so I think the better solution is that you either have to have your money with an asset manager you trust or direct custody, where you take away the power of engagements away from an asset manager that you think might not be acting on your best behalf.
I think there's a real, two things that give me pause. First, Giuseppe, your idea that some people pay for voting and others don't. You're setting up a classic free rider problem. Let's take Silicon Valley Bank. Let's pretend some shareholders realized, regardless of Fed stress testing, that the board was not on top of possible risk from interest rate rises and what that would do to to the risk profile. And there is one little group of investors who's going to vote against the reappointment of the chair of the audit committee, in theory, or file a proposal asking for a more robust stress testing around particular scenarios. That is a governance issue. But there is nothing in that governance model which says one group would pay for the costs of that process. The way it works is, let's pretend it's CalPERS, because Matt and I used to work there, and CalPERS files proposals all the time. If CalPERS files a proposal at the company, for the costs are quite small, they're not prohibitive at all. Then what you have to do is register with the SEC to get permission to talk to your fellow shareholders. And so actually the proposal is not directed to the company, it's directed to everyone else who's invested in the company. Say, hey, do we need to strengthen the audit process? Now, if only some people are paying for voting advice or voting analysis in the same fund manager account, the free rider effect here, I think, is going to be really, really unworkable.
I don't think so.
And the second thing is, many of the issues that we're addressing cannot be dealt with by an individual investor on their own, even a big one, as big as BlackRock or as big as, frankly, Templeton. The $1 trillion club, there's about 10 fund managers in the $1 trillion club. We have to understand or remind ourselves as an investor, there's ideas of alpha, this is, outsized excess return at company level, then there's beta. Now, we all got sick of the Greek alphabet with the pandemic, right? It's also used in finance. But the idea of your main source of return is that it comes from the market. And in the market, there are all kinds of things that will have an impact that are not related to a particular individual company. So global warming is a good example of this. So let's say I structure a portfolio. Here are my bicycle shop and my wheatgrass maker and my bakery in my portfolio. Not worried about global warming. However, other companies in the market are producing emissions. Global warming continues. My little bakery, bicycle shop, and wheatgrass manufacturer is suddenly out of business because of extreme weather events, rising sea level or rising temperature, which means the customer base migrates to different parts of the world or different parts of the county. So you cannot protect yourself from a systemic risk without working with other investors. And that poses this whole question about who bears the risk. And part of what's happened in the United States is the fragmentation of retirement into 401ks has put individuals bearing the costs and the risks in a way that wasn't the case when more people were in these shared investment vehicles like defined benefit plans like CalPERS. So systemic risk is an issue we need to tackle, and free rider effects.
I have to say just one thing on when you, through public companies, engage in, and let's say, constrain companies with regards to emissions or something like that beyond government regulations, what happens? You first have a short-term, maybe demand decrease.
Give an example when you say beyond regulations. Where have shareholders asked for something that is not part of regulation or policy?
American companies signing on to the Paris Climate Agreement, I would
But
say.
America supports the Paris Agreement.
It's not law in America, though. I mean, you would...
It's a legally binding international treaty, and America supports it.
America,
along with 197, I think, other countries.
So then there's no need for the Climate Action 100 Plus because they have to do it anyways.
Well, that would be nice. I
But
love
they don't
that
have
idea.
to. They don't have to.
Hey, Strive says.
I think most people in this room would agree that asset managers have asked for disclosures, and disclosures are a soft form of regulation. They do change behavior that would constrain corporations beyond what they might do otherwise, beyond what would legally be allowed to do. If you can agree with that.
I don't think
okay.
that beyond what you're legally allowed. I guess this sounds very pedantic of me, but there is a narrative there that investors are asking for something which isn't legal or decent or good for returns. And I'm really serious when I say give an example, because when I look at the Climate Action 100 plus space, it's trillions of trillions, but it's all lined up around the Paris Agreement and the subsequent clarifying agreements that are done at intergovernmental level. Nobody's kind of improvising, coloring outside the lines with new ideas that shouldn't happen. And that international legal treaty is based on science.
We can debate it. Based on science or not, it doesn't matter. I think it's an international
the science
treaty
really does
that
matter.
Corporations in America would not have to pay attention to without breaking the law. But regardless, let's just say that I'm correct for a second. If I'm correct, and you are...
So.
No, I'm just asking for an example.
Okay, scope 3 emissions.
Yes.
Yes, reporting.
Yes.
Does corporations legally have to do that in America? Every corporation.
It isn't a legal requirement, so you've invented something that's not real.
So when there's a proposal to ask American corporations to report on scope 3 emissions, and Chevron's board recommends to not vote for that, you're saying that when BlackRock, State Street, Vanguard, CalPERS vote in favor of that, they're voting in favor of something that is required by an international treaty.
No, you're missing a trick here. There's the framework of policy and regulation that sets the boundaries. Then, sector by sector, stage by stage, companies have to work towards an ambition in the future. So we're saying net zero by 2050 on emissions. That has to be done in stages, and it won't go in a straight line. So what we're looking at from an investor point of view is what's the information we need in order to price the risk and make sure that the companies we're invested in are going to thrive, survive and thrive through that process. So if you're an oil company, like Chevron or Exxon, where this same proposal did pass, the logic behind asking for scope 3 emissions is that's where 85% of the emissions lie. So if an oil company provides you with just scope 1 and 2, you're getting a teeny weeny piece of the picture. So what you're looking for as a portfolio manager is all the relevant information to the risk and return and the pricing of that risk. So that's not about, if you're going to say it's a legal duty, I would reference fiduciary duty, which is your duty to be prudent and loyal and act with care, which means you need all the relevant information for making an investment decision.
Can I go back to a...
Just,
I want to go back
one
to...
point to finish. Just one point, because my point was, I fully believe that we are constraining companies in America beyond law. And when you do that, you actually create a short-term demand destruction. Then you actually create opportunities for the private markets to create outsized returns. You don't actually solve the problem versus changing the law, which then requires every corporation to agree to the same sets of standards. And I think we are seeing that where certain resolutions pass at some companies, they don't pass at others. And I mean, frankly, we're getting into the private markets because we see a lot of these opportunities pop up.
I think, yeah, Tariq, go ahead.
I thought this is super interesting, almost as a microcosm of, in some sense, this debate's a bit of a microcosm of one of the biggest challenges we have with capitalism today. Because, you know, on one hand, you have sort of, let's call it the right, leaning right-ish, and that viewpoint would be the companies should just focus on making money and, you know, however that happens. And government should regulate, right? That's even Milton Friedman's paper on shareholder primacy talks about the government and political principle. The problem is that often on the right, it's sort of focus on this thing, but there's no talk about political spending, which is kind of like saying focus on good sportsmanship and let the referees do their job, but the referees haven't been doing their jobs for years and they're taking payments. On the left,
Yes.
right? So that's effectively a libertarian argument, right? I mean, it seems to me like, again, I'm not American, so I'm just going to take an outside observer view. But you have on the sort of left view is that you have this low-hanging fruit, the businesses, if they just look at all these risks and other material indicators they haven't looked at, but in theory they've looked at for decades, like before the acronym ESG, we were looking at environmental liability and other stuff. But if we do more of this stuff, then there's value to be created and you should be doing it. And arguably, they were already doing that, right? I mean, ESG considerations existed before the UN had some report that coined the acronym in 2004. And so it's kind of like a libertarian debate against a neoliberal debate. And at some point, you're like, Milton Friedman would have agreed that we need a carbon tax at this point in time, right? So would Adam Smith. Like any of them at this point would have said that that's the case. And again, it's not to single out Larry Fink, because I think generally it's the industry. But he's arguing against a carbon tax at the last COP summit. I mean, at some point, it strikes me that this is not the right conversation because it's not about divestment and engagement. You know, there's regulation and it exists, and the longer that's ignored, it actually probably creates the biggest risk for companies entirely because political polarization will continue to increase. And that's clearly not in the long-term interest of any shareholder or in corporate America's interests.
So how do we, just to go back to your original point, which was BlackRock's unsuited for dealing with these issues, right?
You mean in terms of, I mean, it's ridiculous. I mean, they have no democratic legitimacy and their incentives are not aligned with the public interest.
Correct.
I mean, the bizarre thing about, we're talking about a market failure. If you have a system where people are, all the chains are governed by fiduciary duty and there's more money to be made polluting than you need for it to be, then capitalists can keep flowing in that direction. And I think the mistaken assumption that a lot of the sustainable and ESG stuff helps is based on this idea you can categorize fund flows. You confuse boycott and divestment. You say less good people are investing in bad things, so less bad things will happen. That's not how it works. I was a distressed investor, right? I mean, if good people don't buy it, it's like saying there's a $20 bill on the ground, no one's going to pick it up. If that's the case, the market system clearly doesn't work. It's just a whole bunch of distressed investors who are going to fill that void. And the concern is that ESG assets and all of this nonsense, the stuff in the marketing is growing at the same time as emissions. People are filling out questionnaires and boards are sitting there wondering how much of this is real and how much of this is the millennial marketing strategy, right? And that doesn't strike me as being incorporated in Americans' interest.
So what do you do then?
Well, one of the things we've got to do is get a total portfolio look, and I think Matt mentioned this when he was talking about private markets. We're talking about proxy voting as that's the only thing you could or should or would do. Publicly listed companies are an ever-dwindling piece of the overall world economy. And for investors, private markets are increasingly important for those returns, for the beneficiaries, and that's important. But these same conversations are trickling into the private markets as well. So, CalPERS with Carlyle launched this ESG data convergence project. I think there is now over 10 trillion in private assets signed up for standards and reporting on emissions, diversity, health and safety, and interestingly, net new jobs created. Because that's one of the...
And then we don't have any of these passive funds in the middle.
Well, you may still have passive funds for the public company, but we've got to look
I meant for your Carlyle CalPERS thing, or is that? In other words, the privately held companies that are getting this getting these investments that are focused on, taking care of, thinking about the big picture issues.
Right.
It's actually much more efficiently done
Yeah,
than the
because-
public markets where we have
Sure, 'cause-
Larry Fink's letter supposedly influencing us.
Because
It is
we're
not
not-
just a way to
because
bring
we're
it to
not-
the private market the same issue on the public market. Every
But
time
you're
I
not
hear something that is
diversifying.
creating a new product, it's all about a commercial spin. ESG is the greatest marketing tools. This industry lives about acronyms, about themes, about thematic things. That's how I grew up for the last 30 years. It's all about creating something fashionable. And ESG of two things totally dishomogeneous, which is foolishness, simply to put the E next to the S and next to the G, other than seems cool. No, it's just to creating now. Maybe you are telling us that in the private market we're going to see what we're seeing in the public market for the last 3-5 years. It's
I
hilarious.
think it'll work differently, and here's
It's
why.
hilarious.
First of all, we don't have modern portfolio theory. Even with BlackRock, they might be very big, but they'll always be a minority shareholder. The difference with private equity, just to take that section, is asset owners, LPs, GPs can organize much closer and tighter control of companies. And you can write your requirements in on whatever the issue of the day might be into your shareholder agreement. And that's been going on for decades at places like the IFC, at the World Bank, and at the development banks and so forth. So what I'm saying is that capital deployment is the big part of the story now. The proxy voting is just one piece of it. We've got to look at fixed income, and Matt, I know that's your area of interest and expertise, but what's happening in the credit markets, what's happening in alternatives, infrastructure and so forth, is honestly where I think the action is at the moment. And just a whisker over $1 trillion in US dollars went into a green labeling, in private markets. The technology potential, the policy drivers and the money flows in private markets are much stronger, greater and more powerful than what's happening in the public markets, I think. And that should be the discussion.
This is a debate I've heard quite a bit in the academy, that the political markets or political process is not working, right? And so we should rely on the corporate process. The corporate process relies on lobbying, right? So we only have a couple minutes left, and there's Ethan said as well, what do we do? So I'd invite everyone, if you can do it in 30 seconds, where do we go from here? Giuseppe?
I don't think anybody has any magic receipt. I think that, if you hear about some of these comments, it all goes eventually whether we should do more, we should do less. We haven't got the time to discuss, but I think it will be already a major step forward if at least this industry, our industry, asset management industry, will do what they say we do. In fact, our position, for instance, against BlackRock, which has been mentioned a number of times, is not about BlackRock should do more or should be less, but at least they should do what they say they do. And what apply to them apply, to a lot of other asset managers.
Anne is right that right now the private market is stronger and maybe this push, but I think that this debate started in the public markets last year. It's going to quickly move to private markets, and it creates great opportunity for Strive. But frankly, I care about the funded ratio at CalPERS. My parents have a retirement there, and I think that you can't regulate through the private market, through the corporate sector. You have to do it through the government. And if you don't, you're just going to create these opportunities for, call it red states, purple states, Strive, whatever you want to call it, that is just trying to maximize return. And who gets left holding the bag? I think it's ultimately CalPERS, and I don't like seeing that.
I'd say, a couple things. I think for boards and advisors, I can't see any, based on this panel and where the world's going, I suspect that you're going to have to deal with these issues a lot more. And I think that's going to be a challenge to figure out which are substantive questions and which ones are sort of, again, just a lot of noise, but the noise is probably going to increase. And I think that for society, the way we get around this is we start having serious conversations. In 2018, right around the time I started at BlackRock, Larry Fink's letter made waves, and he said, the government is failing, and therefore businesses focus on social issues. I've written extensively about this. Business not has a democratic legitimacy or the incentives to do it. The answer is the obvious one if we believe in democracy. It's we have to fix the government. And that's the question that really people should be having more broadly.
I hope that's right. I'm not as optimistic, and that's why I think there's going to continue to be a transition in the public markets. I think that, for better or worse, that's that the public markets are going to. This debate is not going away in the public markets, and maybe we'll reach a point where we'll start reining in corporations and making them realize that they have charters, that they are governable. The idea of a corporation is not like a human being who could just do anything under the First Amendment otherwise. So we'll see. But until then, I think there's going to continue to be an avenue in the boardroom to try and address these issues.
Okay, stop talking in acronyms. That would be it.
Yes.
All right.
So I know I was joking a while back, said RIP to ESG. Last time I know RIP is an acronym, so I'm only joking. But no, we've actually got to get back to the basic. What's the purpose of finance? The purpose of the corporation, private, public, and actually try and dig in a little bit to what these systems were invented for. You know, the company is a creature of statute, not of nature.
Right.
It's a human invention. It was invented and explained in the 19th century. So we're using a 19th century model with 20th century regulation for 21st century complexity and global problems. So, and also let's just lighten up a little bit and make this all a bit more fun and practical. That would be my advice.
I'm certain these are not the last words, but they're going to be the last words on the stage. So please join me in thanking.